This is video 4 of SciCat Limited, combining debentures in IFRS 9 with IAS 8. We are busy with the journal entries of what should have been done. We have already looked at the first journal entry, which is initial recognition. We know that the financial asset, the investment in the debenture, needs to be recognized at fair value, and we went and we calculated the fair value by using discounted cash flows. So now we go over to the journal at the end of the first reporting period, 28 February 2012, and that is first of all the finance income. Now the finance income, how do we calculate that? It is the balance on the debenture T account times the effective interest rate. Now the balance in this case was initially the fair value. There were no transaction costs that initially changed this balance. Therefore, the effective interest rate is also equal to the market related rate you used to calculate your PV, which was your fair value. What else happens on this date? You receive two things from the issuer. Now, we did the two journals combined, the two amounts we received. You could have done two separate journals. The entries would have been the same for both debit, bank, credit, investment. What amounts came in cash? It was the cash flow interest. So how do we calculate that interest? Nominal value times nominal rate, and then the first maturity payment. Together, that is the amount that flowed in cash. You can do them into separate journals. Then we can calculate the balance of the investment in the debenture at the end of the first year. We go over to the second year. We go down the timeline. The first thing that happens is at the end of the reporting period, we have earned interest. We need to calculate the finance income and recognize that in the splocky. How do we do that? We take the balance on the T account. What balance was there? What amortized cost was there that earned interest for the entire year, times the effective interest rate, which in this case was the same as the market rate because there were no transaction costs. Then what else happens? We have two amounts that flow in cash. We did a combined journal. You could have done two separate journals. What is included in here is the interest received in cash and the second maturity payment. That gives us a balance on the debenture at the end of year 2. We go down the timeline, we get to the end of the third reporting period. The first thing we need to recognize is the interest that was earned, the finance income. How do we do that? Finance income is the balance on the T account. What balance, what amortized cost was there the entire year that earned interest, times the effective interest rate, which in this example was equal to the market rate because there was no transaction cost. And then the second journal, again, we did it together. You could have done two separate journals. All the cash flows that happened on this date was the interest that flowed in cash from the issuer to the investor, together with the third and final maturity payment. That should give you a balance at the end of year 3 when the entire debenture has matured of 0 Rand. In this case, there was a rounding difference of 1 Rand, but effectively the debenture was completely matured, no investment left, nothing left in our accounting records. Everything was repaid by the issuer. We now need to have a look what is the difference between what was done and what should have been done, because those differences tell us what we need to correct and also how the financial statements will be changed. So if we have a look at the first reporting period, the period that ends 28 February 2012, if we look at that first reporting period, what was done? What items were affected? What items do you see? Well, we see investment, again investment, again investment. Bank will not be a problem. Bank, the amount that flows in cash was the same between what was done and what should have been done. So the only other item that is there It's the investment and then the finance income. Those were the two items that we had when we looked at what was done. Now we look for the same period at what should have been done. What items do we see here? Again, investment, investment, investment. So there's definitely an investment in what was done and what should have been done. We need to look at if the amounts are exactly the same. Bank won't be an issue. What other items do we see here? Well, we see a fair value adjustment that was not there when we looked at what was done. And then we also see finance income, which could be at a different amount between what was done and what should have been done. So if we talk about the statement of profit or loss for 2012, what was done and what should have been done. What was done was that there was finance income recognized of 4,000 Rand. What should have been done is that there was finance income actually of 3,621. So when you compare the two amounts between what was done and should have been done, you would see that your finance income actually went down. That means if an income goes down, the profit for the year will go down. What else was there for the statement of profit and loss? There was a fair value adjustment. What was done, there was no fair value adjustment because everything was recognized at cash. What should have been done is there should have been a fair value adjustment, which was an expense of 1,724. So expenses increased, which means that your profit actually decreased from what was done to what should have been done. So your profit decreases with two things: the finance income and the fair value adjustment.